with the money market, and we're looking at contractionary monetary policy. Okay, again, we're going to show you two graphs side by side. So the first graph on our left is money. Normally you'll only have to draw this graph. However, I think it's useful to have it right beside investment to show how it impacts investment and how it then runs through our line of logic, which I'm showing down here. So money market has a price of interest rates. The value of money is determined in interest rates. So up here we put NIR for nominal interest rates. Nominal interest rates are also used as our investment measurement, right? The only time we use real interest rates is when we're talking about loanable funds. Down here we're going to have the quantity of money. And then over here we're going to have the quantity of investment because those are the markets we are specifically looking at. Okay? Now, money is going to start with a downward sloping demand for money. Demand for money is made up of two elements. It's a D, kind of hard to see, but that's a D. Two elements. It's made up of the demand for money as an asset. Demand for money of an asset is the amount of cash you hold instead of investing money, right? So this is the amount of money you have underneath your mattress, for example. Now, when the interest rate falls, I hold more money in my mattress or in my bank account rather than investing in bonds and stocks because those low interest rates, those bonds are not very attractive, the stocks are not very attractive. So instead, I just hold on to my money. But when interest rates rise, the opportunity cost of holding on to that money gets too much, and the quantity of money I demand goes down. So that's why demand is downward sloping. It's made of that and the demand for money for transaction. That's just literally the amount of money you need to make your purchases. When GDP rises or nominal GDP rises or inflation rises, I demand more money for those transactions. Okay, next we have our supply of money. I'm going to pop it right here. That is a vertical curve, right? And it's vertical because it is 100% controlled by the Federal Reserve. So we'll call this Q1. Now, our starting point is going to be at the equilibrium here. We dash over, and this gives us our initial interest rate. We call this IR1. Now, I want to enact contractionary monetary policy, which means I currently have an inflationary gap, and I want to reduce GDP, right? As you can see here, I want to reduce GDP and push down the price level, pulling back inflation and avoiding hyperinflation. So the way that the Fed does this is by decreasing the supply of money. They decrease the supply of money in one of three ways. Either they sell bonds. By selling bonds, they put bonds into the market and take money out of the market. So people give them money, that goes out of the market, they get bonds in return. That's a transaction. So the quantity of money in the market falls. Or they can increase the reserve ratio, which gives banks fewer loanable funds to give out and create money. Or they can increase the federal funds rate, which makes it more difficult for firms to get loans from the Federal Reserve, and so they're less likely to lend money out. Now, all of those, whichever one they choose, is going to cause a decrease in the supply of money and push our interest rates up. That's all well and good, but how does this affect my entire economy? In order to figure that out, we have to jump over here for the demand for money as investments. So we have our downward sloping demand for money, so we call this the DIG, D-I-G, the demand for investment. We see initially at IR1, a lot of investments were demanded, right? Because the interest rate was low and businesses buy investments like machinery and capital goods with loans. And so when interest rate is low, they're more likely to take out that loan and get a good return on their investment. However, when the interest rates went up due to a decrease in the supply of money, we see that our demand for investment has actually fallen. And this is because there are fewer profitable investments because they're more expensive to buy, right? The borrowing, the loans that have to be used to buy those factories or those machines are pricey. So when the demand for investment goes down, investment decreases here, that leads to a decrease in aggregate demand shifting it left, leads to GDP falling, and pushes our price level down. Now, of course, whenever we are dealing with interest rates, we have all kinds of questions that can be asked in relation to that. Oftentimes you will be. They'll ask, for example, what happens to bond prices here? Well, we know there's an inverse relationship between interest rates and bond prices. So when interest rates go up, bond prices are going to go down. They might also ask what's going to happen to the supply of money. or the demand for money in our current market, the demand for the US dollar, for example, in the foreign exchange market. Well, when our interest rates are higher, foreign nations are going to want to buy our bonds. There's going to be capital inflow as people buy our bonds, and that's going to increase the demand for our currency. It's going to appreciate our currency, which in turn decreases our net export. We're going to ask questions related to those. Just make sure you know how interest rates are connected to the rest of the economy. All right, that's all I got for this one.